The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions bored of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, Wednesday was a very interesting market trading day. I'll preface it by saying that to start, because we saw a very sharply higher move at the open, and then things just kind of fell out from under us as we went through the day. Here to talk about it, Mike Zuzolo, Global Commodity Analytics, is with us on Market Talk today. Mike, great to have you back on. And you and I were chatting a little bit before we jumped on the air here. What a wild day on Wednesday. And I know a lot of this was tied to the wheat market, but it just felt like as we went through the day, commodity wide, whether we're talking grains, oilseeds, energies too, we were trading, maybe some short covering, and then all of a sudden the bottom let out and we just lost all that momentum. Talk about that a little bit to start, Mike.
Yeah, a lot of layers to peel back here from the onion on this new news of both Cargill and Viterra leaving the grain business in Russia. My understanding is Cargill is going to remain in some other assets in Russia, but in the grain business, it's just gotten too politically and logistically difficult to make money from what we've seen and heard, and what I'm hearing as well, Jesse. And so this news came out, and you think about, as far as the top 10 exporters of wheat and grain in Russia, you're talking about number 4 and number 6. So when you see those numbers, you see 2 of the top 10 leaving Russia, you immediately think, oh, there goes supplies. We're not going to have enough supply now to meet the market needs. And this comes on the heels of last week, where Russia said they probably would not want to export any more wheat, especially given the fact that it's below the cost of production, and they raised their export tariff by up to $70 a ton. Now it's up to where it was back in the middle part of 2022. So they have made several moves before this announcement, signaling to the market that there's going to be less Russian supply out there. The trade, I think, initially took this as the same thing. But as we thought about it, we realized this was not about losing Russian supplies. This was about moving Russian supplies from these 2 U.S. companies to other Russian assets. And I think that's what the trade caught hold of and realized. And in a sense, you didn't see any good reaction in the European wheat markets at all. You didn't see the European wheat up 5, 7, 8% like it was about a week ago. That's what we really needed after this news came out. And so with all that in its totality, in the backdrop of a market that is still very nervous about the banks, very nervous about the demand, very nervous about the USDA reports looming here at the end of the week, it was not hard for the longs to take profit after making so much money so quickly.
Yeah, it just kind of shows how that whipsaw effect can go in these markets, just within hours of trading. And I want to focus a little more in wheat here, as this is our big part of our discussion today. In this chart, I'll pull it up on the video, looking at global wheat exports. And you raised a good point there about how the trade initially was thinking, oh, we're not going to have, these supplies. And then we kind of took a step back and realized that still there. So I walk us through this chart, and let's just expand a little bit more on what's happening in this wheat trade right now.
Yeah, I'm doing this today and showing you and the video people this today because I want to kind of take it back about 30,000 feet and talk about this new East and new West. This is yet another step in the Chinese and the Russians and participating in this mindset, most if not all the BRIC countries, wanting to kind of separate the global trade and break the dominant global trade mindset that we've had ever since World War II, and especially since 2000 when China joined the WTO. And that's where this chart begins. This is the wheat exports for the world in dollars and US dollars. And that's extremely important because part of what is going on right now And again, today's move helps support this thesis, is that the Chinese and the Russians want to get away from a dollar-centric trading world. They not only want to control the commodity supply side, and not only do they want to sell to only their friends in their new trading world, they also want to do it in their own currencies. And so that's first and foremost. This chart is in billions of US dollars. We notice we were only trading about $10 billion back in 2000 at the beginning of the last century. And we are talking about moving upwards of $70 billion just in 21 years after that. That is globalization. That is the market working together, getting along, and seeing competitiveness flourish. Well, I think we're going to go backwards now at this point, Jesse. And I think that's point number one. Point number two is notice the gray part of the bars. That's the United States and their value of exports in wheat throughout this 21-year time period. And we noticed that we really started to build up from 2000 to 2011. And then after 2012, 2013, we just started shrinking in terms of the export value that we were getting out the door. And many countries from around the world, which is the rest of the world, ROW, in the legend, and along with Ukraine and along with Russia, they took our wheat business. And I think this is in part why today we didn't see a price reaction that was lasting, is because we aren't the heart and soul of the wheat market at this point. We haven't been for about 10 years. And until our dollar breaks and until we get more competitive, the way China and Russia are moving in this new sentiment, in this new trading model, we have to have a weak dollar to be able to stay competitive, or we'll lose even more business, in my opinion.
Another chart I'm going to pull up here to expand upon this as well. This is a chart you sent to me for the video, looking at SRW futures and the FAO World Food Price Index. And I have a couple thoughts I want to ask as well, but I want you to run through this chart for us first before we bookend our wheat conversation. So what are you seeing here, Mike?
Yeah, I'm going to take you back from 30,000 feet back down to about ground level in the here and now and say, I'm worried about demand. Like 2022, I think this market's going to be weather and supply driven. But having said that, this chart shows me, because the world price from the United Nations has dropped about 50% from its highs, the soft red wheat price has dropped over 75% from its highs. We've got a discount in this wheat market. We don't have a war premium, and we don't have any kind of weather supply premium at this stage, in my opinion. And so this is why I think the wheat market could really find some support in the not too distant futures, because I do think the hostilities and the war drums are beating louder and louder. You and I talked about this 30 to 45 days ago. It's now starting to happen, not just in Ukraine, but now China is talking about Taiwan again. And there's a variety of other issues, Iran and some other countries that are working against us now in a material fashion. And I think this really does bode well for the price of wheat, unless the US dollar becomes a big safe haven player and everybody runs to that and buys that. So that's kind of the way I'm looking at it in the shorter term. Is this chart shows me that the soft red wheat is very discount to not just what we were back in history, back during those other short crop time periods, but also against the United Nations world food price too.
Well, Mike, you mentioned some of the weather demand side of the equation, and that's one thought that I want to ask you about. I know we have a lot of dryness concerns with the KC wheat crop in the Southwest Plains. We have a heavy snowpack up north that some are chattering about, hey, if we don't get this melted off, we're going to have delayed planting, could have prevent plants. So I wonder, with finding some support, could we possibly be looking at KC and Minneapolis wheat being the leaders in our market trade here for the foreseeable future?
Yeah, I really think so. And again, that weather classification is that supply side of the column. And I think that's exactly right, Jesse. And I think that's especially pertinent once the trade sees the acreage numbers on Friday. We're all thinking what you just talked about in the commodity trade, and your antenna are, as usual, right on target with what's being sensed out there in the commodity world. I just think everything's being put to bed right now and laying low right now until we see USDA's figures. But the top two things I'm going to be looking at are corn acres and spring wheat acres, wondering if we've got tops, or if that's the biggest number that we're going to get all spring long, is what we see on Friday's numbers by USDA.
Well, and with those numbers from USDA, I'm curious, and we'll talk about this for a minute. We know it's a very volatile report, Mike. It always typically is. But thinking about those corn numbers, thinking of what we could see for soybeans, uh, is there any way you're leaning one way or another heading into this report that we need to keep an eye on as far as maybe some worry or maybe be optimistic about? I guess we'll look at it both sides of the coin.
Yeah, I mean, I'm more optimistic about the wheat. I mean, my wheat number is right there with USDA's, but my yield number is much lower than USDA. So I'm a sub 500 million bushel carryover for 23, 24. And as long as I don't get shot out of the water by some weird acreage or stocks number on Friday, I'm optimistic. And that goes back to your question and your thought about the wheat still being our leader, which I think it is. As to the corn and the beans specifically, Jesse, I'm really moving along with the spread, along with the new crop bean corn ratio. And, 3 weeks ago, if you would have asked me what we were buying, we were clearly buying bean acres. Well, that all ended abruptly after the WASDE report back on the 9th of March. And we made a concerted effort to go back and buy corn acres. And so my big question mark is how much will USDA take into consideration that spread or that ratio, because they typically do in their March numbers. They oftentimes will make a comment about that's part of the reason why they did this or that was because the way the ratio was trading as we got ready for the crop insurance numbers. So my sense, my belief is that it's going to be very hard to get much above 90 million acres on corn, but there are some real reputable people out there, including USDA, that are 92 million plus. If we get 92 million plus, I could see that if it comes at the expense of soybeans, that giving the beans the ability to continue this pre-report rally. But I think we've started the rally already this week and late last week in trying to build back some premium because we got of expectations of shorter bean acres.
We are having a conversation today with Mike Zuzolo of Global Commodity Analytics. And Mike, another thought I have too, and I love your thoughts and take on this as we just think about managing risk heading into a big report day on Friday. We obviously also have the end of the month, the end of the quarter. I have to think that that's all going to lend itself to plenty of volatility one way or another on the day on Friday. Talk about how we should think about managing our risk heading into that report day.
Well, it's interesting you bring that up because right before we went on air, I looked at the S&P 500 and we're back up above where we opened this month. But in the S&P banking index, we're still at a 25-month low. And so that tells me we're not out of the woods at all on the banking side of the equation. And so as we close out this quarter, knowing that about 300, almost $290 billion moved into money market funds here in the United States, in the month of March because of the fear of what was going on with the banks. We've got money that's on the sidelines right now, ready to be put back into risky assets if the conditions warrant it, if they see the all clear, if they see the blue skies in terms of the economics and the financials. And I think that does have a lot to do with how we close the month of March out and how it looks for that first quarter. I'll give you an example. I think part of the reason why the crude oil was able to bounce so nicely in the last week or so is because we were running in terms of options, puts and calls. We were running at levels not seen for many years as far as negativity in those option structures. And by some metrics, we were running at 4-year highs in terms of price negativity when it came to the crude oil market. And so we had everybody on one side of the boat. And I think that's what I'll be looking for when we get done with this month and this quarter is, do we have somebody, a big group of people stranded or on one side of the boat and that boat's tipped over, and are we ready to jump back into risky assets? And I think that goes directly back to the banks and the financial situation, and also China. I heard a really great statistic this week. I'm trying to get out there to everybody that I talked to, and it was the head of Maersk, that number 2 shipping company in the whole world, talking about China. And he said that 70% of the savings by Chinese people is invested in the real estate market. So that's why they're not coming out of zero COVID fast. It's because they're scared, and because much of their savings have been eroded by their property market blow up or implosion. And I think that all has to work into the fact of, do the emerging markets, those risky assets, look good again after we close this week out?
Great thoughts. That's something I definitely haven't heard. I appreciate you sharing that with us here today. Let's talk livestock. I want to touch on this hog market first. we had a great day Monday, and then we just haven't followed through. I have to think that this is squaring up of positions ahead of Thursday afternoon's quarterly Hogs and Pigs report, Mike.
Yeah, I think so. And I think the spreads show that. The trade seems pretty confident between the cutout and between the current size of the herd here in the here and now going into summertime. They feel fairly confident of keeping the prices right around that $80 level. The Chinese news earlier this week that they had built up their breeding inventory, I think about 1.8% bigger than last year, which was a surprise to many, including me, that they were able to turn it around so quickly with such they have an endemic African swine fever issue now, and the USDA Ag Attaché of China told us that this week. Given that, they still were able to supposedly bring back their breeding herd so quickly. So I think that kept the pressure on the front end, but most of the negativity has been in the back end, and they've taken a lot of premium out of the summer months. I think indeed because of what they're expecting in this report. Having said that, I don't think anybody's looking for much more than 1% gains in terms of kept for breeding. So if we come in below 101, I think that could spur the summer months. I still think the summer June month, especially as we get tighter in the cattle market, I still think that June could make a run back towards $100.
Mike, how about the cattle trade? Have we gotten to a point, do you think, in cattle where we've pulled back enough that maybe this is our pullback to slingshot back higher, or what are you watching here throughout the cattle market?
Yeah, one of the things that I sent over was a hog cattle spread, and I thought it was a very interesting feature, especially given that I am starting to hear that we've got some packer demand coming in here. And I think the biggest thing that I'm picking up right now is that we are buying cattle and selling hogs in the fund mindset, in the investment mindset. And it's very similar to what we came out of in 2014 and as we went into 2015. And we made the high in the cattle hog spread right around the end of March. I'm kind of looking for the same type or similar pattern here this time around, Jesse, just because of how the hogs have reacted so negatively here during what could have been a very good Easter seasonal. So I guess I'm of the mindset that while we have cattle prices probably underpinned and a floor underneath them, I feel like the funds have put too much premium in them, especially in relation to the summertime hog market.
Well, and I wonder too, with all the banking worries, of course, and waiting on summer grilling season, I think it's going to be an interesting couple of months here in both the cattle and hog trade, just overall watching to see how everything ebbs and flows, Mike. And we've talked about that quite a bit here in recent weeks.
Yeah, we really have. And I think those export sales are really meaningful, especially to the hog and the pork sector, because if China does have any problems, or if they're saying their breeding herd is bigger than what it really is, it should show up with them buying more of our pork.
Well, Mike, great thoughts as always. Before we wrap it up today, got a few minutes here for final thoughts from you. Anything else you want to reiterate for folks today?
Yeah, still working that dollar crude relationship. That's still working very, very well. I'll just keep saying that until it doesn't. And then that way we can get an idea of when those two break apart. But I really do think the difference between Russia and the wheat markets is really going to end up being the issue with the dollar, and whether the trade buys it or whether the trade sells it, because of this new mechanism that Russia and China are trying to set up. And that will be, I think, good for us in the end with the weak dollar and bring our demand back home.
Well, Mike, I know a lot of information out there right now. If folks have questions, they want to look at your analysis, get some advice, I know they can reach out to you very easily. What's the best way?
Globalcomresearch.com is the best way, Jesse, and it's globalcom with two M's, research.com, or call me toll free 866-471-2588 after the market closes. Be happy to talk to you.
Well, we always appreciate you talking to us and sharing your insight. Mike Zuzolo, Global Commodity Analytics, thank you so much for joining us today, sir. Have a great week, and we'll talk to you next week.
Thanks, Jesse. I appreciate you too.
And that's going to do it for Market Talk here today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.